Hello and welcome to FT Markets. The topic today is emerging markets in general and Brazil in particular. Is Brazil in fact experiencing what might be dubbed a Caipirinha crisis? To help us consider that, we're joined today by Alberto Gallo, Head of Macro Credit Research for RBS. Thanks for joining us, Alberto.
Thank you.
So first, I think you've got a good chart here. Why don't you sort of put some of the overall emerging market situation in context for us?
Well, what you see here is that over the last decades, we had a super cycle in credit. Countries in developed markets and emerging markets grew private debt by a multiple of GDP. So credit was used as a way to boost growth. In the US, we had a small deleveraging and now we are releveraging. The Eurozone is still trying to deal with the losses from the crisis. And then what you see in emerging markets and China is that we never really had a credit crunch or a deleveraging there. Credit is still being used to expand growth, especially in China with the last stimulus program. Private credit has doubled throughout the crisis.
So no crisis yet in emerging markets, nothing like the developed market experience.
And the question is, how can this continue? And obviously, a lot of this has been fueled by inflows of capital. What happens if these inflows stop or reverse?
Yeah. And this is true for lots of emerging markets, but I think if we look at our next chart, Brazil in particular is something we should be thinking about.
China has grown a lot on their credit and their investment, and now they are stopping. But China can do it in a controlled way with one party and one government. The real risk in our view in EM are the countries that have been pulled by China growth, that are less diversified and a lot more dependent on commodities. Brazil is one of them. It has, and potentially the most vulnerable in emerging markets. It has 1/3 of exports in commodities. It exports 1/5 of total to China. And what you see here is that the economic situation is deteriorating with lower GDP growth, higher inflation. The central bank has hiked rates aggressively in response, but it is a very difficult situation to manage. The government is now down to 7 parties in the ruling coalition, and we face an impeachment, we think, in the coming months.
So so Rousseff could go, and then not only is the politics looking bad, but the economics are looking bad.
Yes, politics and economics, and the corruption scandal in the government has involved a lot of large Brazilian corporates, including obviously Petrobras. We think we are at the beginning of a credit crunch with non-performing loans in the banking sector starting to rise, and banks so far have engaged in a very loose forbearance practice. They're still growing the loan book. They're lending to corporates which potentially are not viable. But this at some point may stop, and it stops with capital outflows, which are already happening in the currency and sovereign space.
And I think you were saying to some extent the growth in the loan books for these banks hides the underlying deterioration in some of the non-performing side of the balance
Exactly.
sheet.
When you calculate non-performing loans, you have bad loans as a ratio of total loans. If you increase the total loans, the ratio looks lower, and banks are increasing the total loans by 10 to 30% year on year, still in an economy that's deteriorating. I mean, clearly, this is not something that can continue for a long time.
Yeah, once that growth stops, then we start to get into trouble. And thinking then about the credit side of things, the sort of the emerging market corporates, I think we've got one more chart here. So far, emerging market hard currency credit has actually held up pretty well this year. It's been one of the better performers as investors have started to worry about various other parts of the fixed income world. So what are we looking at here?
So these are the flows in EM sovereign debt, including local currency, which have basically erased all the inflows. And these are flows into cumulative, into corporate credit. Now, what we saw before is that this time around, it's not like 97. The original sin is not in sovereign debt in dollars or euros. It's in private debt, in corporate debt. So it is corporates that have used foreign currency to fund at very low rates. Nevertheless, in the corporate world, flows and valuations, risk premium remain very contained. In other words, while macro people in sovereigns and currencies are very worried about the crisis in EM, investors in credit and corporate bonds are more focused on balance sheets, are probably less aware of the macro risks. But we think this is going to change, and we think that the next leg of the EM pressures will be a credit crunch. Obviously, there are good and bad EMs. Brazil is one of the most exposed, but in my view, it's a bit like choosing the good EMs. It's a bit like choosing a good street in a town where you're going to have an earthquake coming. So there is, coming from this, there is very little place to hide.
Thank you, Alberto. So it seems like a potential earthquake coming in emerging markets, possibly originating in Brazil. Is it going to be a Caipirinha crisis? Investors may well need a stiff drink.